Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello, everybody. Ben Rains here for Top Stock Picks at Zacks. Today, I'm looking at Veeva Systems, which trades on the ticker VEEV. Veeva Systems is a cloud software stock that looks ripe for a breakout after chopping around for the last few years. So overall, Veeva's various cloud software offerings serve vital segments of the economy, from pharmaceutical giants to biotech upstarts. Veeva sells cloud-based offerings that are geared towards the entire pharmaceutical and life sciences industries. Some of its biggest clients include firms like Merck, Bristol Myers Squibb, and beyond. They all use Veeva's offerings. It helps clients improve and streamline their critical business functions with software and services for research and development, regulatory processes, and compliance, which is a big deal for them, safety, clinical trials, marketing, and beyond. Its technology enables its clients to, quote, bring products to market faster and more efficiently while maintaining compliance. So maintaining compliance is a huge factor of their business. Veeva finished fiscal 2025, with roughly 1,500 customers, including 1,100 in its R&D solution segment. And overall, it's grown its sales from just roughly $210 million back in its fiscal 2014 to $2.7 billion in its recently reported fiscal 2025, with sales up 16% last year on 20% higher subscription services revenue. On top of that, its adjusted earnings grew 36% last year, and it provided upbeat guidance on March 5th. So let's dive into a little bit more about Veeva Systems. All right, so the first thing we're going to do is we're going to take a look just quickly at Veeva's website. You can see just all of the various segments of the biotech and pharmaceutical world that they help serve: clinical, regulatory, safety, quality, medical, commercial, data, all of that. So just that gives a sense of how big their business is and how important it is to their various customers. And as I said, they're the way to kind of add exposure to this critical area of the economy with huge growth without kind of the boom and bust cycles of, say, a biotech upstart or some of these pharmaceutical stocks as they roll out new drugs. So Veeva offers some nice exposure to that. So now we're on our Zacks.com ticker page for Veeva. We can see it's a Zacks rank number 1 strong buy right here. We can see that its industry is in the top 14% of roughly 250 Zacks industries. So let's go quickly to our detailed earnings estimates page here. We can see that on top of big growth last year, on the top and bottom line, we're calling for another 11% growth in fiscal 2026, and then another 12% growth next year. So steady double-digit growth in the top line to get up to about $3.4 billion next year. And then the bottom line, we're calling for 10% growth this year, and then another 11% growth next year. So really steady growth. And since that March 5th report, its earnings estimates are going heavily in the right direction. So we can take a look here, go to our snapshot page. You can give a sense of where the earnings revisions are trending. So up about 7% for Q1, about 4.5% for fiscal 2026, and another 4% for 2027. So we can see that its estimates had kind of stagnated recently, which is part of the reason its stock has kind of chopped around. But we can see these blue and gold lines trending heavily up in the right direction now to help it land that Zacks rank number 1 strong buy. Now we'll go over to our ZRS system here. So we can see this is over the last 10 years, VEEV, so VEV stock. Veeva Systems stock is up roughly 815%, blowing away its highly ranked, the broader medical sector, which is up just 4% over the stretch. If we go to the last 5 years, we can see that it has stagnated. So it took a dive along with the broader market throughout 2022. And then over the last few years, it's still kind of just chopped around. So we can see it's up around 6% compared to that broader medical sector, which is down actually 17%. So it's been a rough stretch for the entire sector. And we can see, though, if we'll take a look at a technical chart and maybe give a sense of why it's possibly ready to break out. Let's go to a 10-year chart. We'll get rid of some of these trend lines here, delete all these. So we can see it's hugging this 21-week moving average recently as it's kind of chopped around. So it hasn't broken higher, but it hasn't broken lower either, while trading at roughly neutral RSI levels on this decade-long time frame. So if we go to the last 3 years, it's kind of chopped around, failed to maybe break out to new highs recently. But it's one of those ones that once it has maybe a positive catalyst at when it reports its earnings next, it could be ready to break out. And we can see that if we look at it, we're going to go to its PEG ratio, which factors in its longer term earnings growth outlook. We can see, once this chart pulls up, that we can see that its valuation is coming way down, and it's now at 1.7 in terms of PEG ratio, which is closer to its medical market, or the broader medical sector, even though it's crushed it over the last decade. So its valuation is improving as well, which is a great sign, even though the stock is kind of chopped around. So it definitely looks one that could be ready to break out in the coming weeks or months. All right, so wrapping up here with Veeva Systems, artificial intelligence is going to be a key growth for the entire market. So they have to continue to roll out more AI offerings, as it's going to become really critical to all the segments, including its lifestyle industry businesses that it serves. On top of that, it's going to continue to be able to grow through maybe acquisitions, because it has a really stellar balance sheet. So it has $7.3 billion in total assets, including roughly $5 billion in cash and equivalents, next to just $1.5 billion in total liabilities and zero debt. The company operates an essential business that provides investors access to biotech and pharmaceuticals without really the boom and bust cycles that are common for those segments. So investors might want to consider putting Veeva on their watch list, or maybe buying it at the moment. And that does it for me. So now I'm going to send it over to Tracy.
Thanks, Ben. So these are very challenging conditions to be picking stocks. That's why we're relying on the Zacks #1 rank strong buys to give us some insights into companies that are still crushing it on the fundamentals, even while all this market volatility is going on. So my stock this week is Sterling Infrastructure, ticker STRL. And I chose them because I own them in the value investor portfolio here at Zacks and in my own personal portfolio. Their name kind of says it all. They are on the infrastructure side, but this is a construction firm on the infrastructure side, and they're a mid cap. So I do like it that they're on the smaller side with a market cap of just 3.5 billion. So they are in 3 different segments. One of them is the data center. So that's why the stock has been so hot over the last couple of years. They call it e-infrastructure. But in that category includes the data centers, but also distribution centers, manufacturing facilities. What do we want to bring back? Manufacturing. So I'm expecting good things even outside of the data centers for Sterling in that category. They also have a building category, and this is where they pour concrete foundations, both in residential and commercial construction. Now, residential has been challenged, and they've talked about this. So until the home builders start to really pick up on the sales side, that segment is going to remain challenging, but they will eventually. So I have no doubt that it's going to rebound there. And then their third is transportation solutions. And that is the build out on the infrastructure and rehabilitation projects in highways, bridges, airports, all things transportation, wastewater, drainage, that kind of thing. So I like all the areas that Sterling is in. They have a very nice backlog right now, and the shares are now down 33% year to date. So you're getting it much cheaper. It's got a forward PE now under 15 in the 14s because of the share pullback, and a PEG ratio, which is both value and growth, under 1, which is a classic PEG ratio you want to see. And that's because those earnings are still expected to grow. So let's take a look and see why it's got the Zacks #1 rank right now. And it actually has a VGM score of the highest score of A as well. And that's because it's got great style scores. So let's take a look here. So I'm on the detailed estimates page on Zacks.com, and just scrolling down, you'll have the sales estimates there. And you do see a little bit of pullback this year on the sales side, then rebounding next year. But earnings expected to be up 34% here, and then another 14% for 2026. This is great earnings growth. And you can see after the last earnings report, the analysts raising. There's not a lot of analyst coverage on Sterling because it is on the smaller side, but we've got the earnings estimates increasing there. And then look at this. Over the last 30 days, we're up to 821 from 723 30 days ago as it reported those earnings. And then next year, even the analysts thinking, oh, we're being a little conservative here too, even just based on the data center build out. So this is very cheap. And what does it look like on the chart with that sudden increase that we're seeing this year? My favorite chart, price and consensus. And you can see this is a great chart. So steady, consistent since the data center and AI revolution story took off. Back here is where it started taking off. And then we had gains. And then this year, whoops, we're still behind. Big gains coming here, but we've got the stock selling off back to 2024 levels. It feels worse than that. But if you liked it in 2024 on those rising earnings, we have to like it even better here. Like I said, it's gotten a lot cheaper. So those of us in the value investor category, we're liking it with a PE under 15 there. What does it look like? We've got some other good charts on the quote page, and I like to go to those. So even the price consensus and surprise chart, you can see all these surprises in here now. Even last quarter, it's surprised again. And so this is a great chart as well when you combine it in with the earnings surprises. But down here on the sales and EPS growth rate chart, it will show you what we just see on the price of consensus in this type of bar chart. So I like looking at that as well. And you can see the nice rebound in 2026 that's expected off of those sales, but just a little bit of pullback here. And maybe that's spooking a little bit, plus all the spooking about AI and that it's not going to happen. And we won't see this build out, or maybe we will, and the stock will remain this cheap. But I'm liking anything in the AI revolution play here because it's not over yet. And Sterling, cheap, and it's got the growth. So this is a double whammy stock with the number one rank. And that's what we like to find here every week on the top stock picks of the week. So be sure to join us next week as we bring you 2 more top stock picks, including some of these that have pulled back. They've still got the number one ranks. And we're bringing them to you every week here. Be sure to get them all on YouTube. Go to Zacks.com/YouTube. Just put in Zacks Investment Research if you don't want to do it that way in YouTube, and you'll find our channel. Be sure to subscribe, and we'll see you again next week with some more top stocks.